Right now on TikTok and YouTube, creators with millions of views are telling you to lie on your mortgage application. They call them hacks. The federal government calls them wire fraud, bank fraud, and conspiracy, charges that carry up to 30 years in federal prison. In 2024 alone, financial institutions filed over 43,000 suspicious activity reports related to mortgage fraud. And some of the people who followed this exact viral advice, they're serving time right now. These are the 7 mortgage hacks going viral, why each one is a federal crime, and the legal strategies that actually achieve similar results without destroying your life. Here's what most people don't realize. Mortgage fraud isn't some niche white-collar crime that only happens in movies. According to CoreLogic's annual fraud report, 1 in every 134 mortgage applications contains fraud. That's nearly $130 billion in loan applications with some form of misrepresentation every single year, and the FBI doesn't take it lightly. Their financial crimes unit ranks mortgage fraud as one of its top priorities, right alongside public corruption and corporate fraud. The reason this matters to you? Social media has made it incredibly easy for bad advice to go viral. A creator posts a hack that gets 2 million views, thousands of people try it, and the FBI suddenly has thousands of new cases to investigate. The penalty for federal mortgage fraud: up to 30 years in prison, up to $1 million in fines, and a permanent criminal record. Let's break down exactly which hacks will get you there. This is the most common one you'll see online. The hack goes like this. Tell the lender you're going to live in the property as your primary residence, get the lower interest rate and smaller down payment, then rent it out as an investment. Sounds harmless, right? It's not. Occupancy fraud is a federal crime under Title 18, Section 1014, and lenders actively check. They verify your address through tax returns, utility bills, mail forwarding records, and even random physical inspections. In 2023, a Colorado man was sentenced to 12 months in federal prison for occupancy fraud on just 2 properties. 2 properties, 12 months. But here's the thing, the legal alternative is actually better. It's called house hacking. Buy a duplex, triplex, or fourplex with an FHA loan, just 3.5% down, live in 1 unit, and rent out the rest. You get investment income, satisfy the occupancy requirement, and you build wealth without a felony. Some investors have built entire portfolios starting exactly this way. The second hack: flooding your feed. Inflate your income on the application. Maybe you're self-employed and someone tells you to round up your earnings, or add a side income that doesn't exist. This is bank fraud, plain and simple. Under federal law, making a false statement on a mortgage application carries up to 30 years. And here's why people get caught. Lenders now use automated income verification. They pull IRS transcripts, called 4506C forms, directly from the IRS. Your stated income gets compared against your actual tax returns in real time. In 2022, a California mortgage broker named Tamara Dadian was sentenced to 15 years in federal prison for an income fraud scheme across just 25 loans. 15 years. The legal alternative that most people don't know about: non-QM loans. Bank statement loans let self-employed borrowers qualify using 12 to 24 months of bank deposits instead of tax returns. DSCR loans qualify you based on the property's rental income, not yours. These are legitimate products from real lenders, designed specifically for people traditional banks overlook. Here's one that sounds like a favor for a friend, but ends with both of you in handcuffs. A straw buyer scheme is when someone with bad credit gets another person to apply for the mortgage in their name. The hack says, just have your cousin buy it, then transfer the title later. This isn't a loophole. It's conspiracy to commit bank fraud, and everyone involved gets charged. The buyer, the real purchaser, often the real estate agent who helped arrange it. In 2024, a ring of 12 people in Georgia received sentences ranging from 2 to 8 years for a straw buyer operation involving 9 properties. But you don't need a straw buyer. If your credit isn't ready, you have real options. A co-borrower, someone who actually lives with you and shares financial responsibility, is completely legal. You can explore lease-to-own agreements, FHA loans with credit scores as low as 580, or state-funded down payment assistance programs. Over 2,000 of these programs exist nationally, and most buyers have never heard of them. Number 4 is sneaky, and it's the one people think they'll never get caught doing. The hack: don't tell your lender about a car loan, personal loan, or credit card debt so your debt-to-income ratio looks better. Here's the problem. Lenders pull your credit at application, and then they pull it again right before closing. It's called a soft credit refresh, and it catches new accounts, balance changes, and hard inquiries that appeared between application and closing day. If they find undisclosed debt, your loan gets denied at the closing table. You lose your earnest money, your rate lock, and potentially the entire deal. But if it somehow slips through, that's material misrepresentation on a federal document. One buyer in Texas had their loan called due in full. The entire mortgage balance became immediately payable 18 months after closing when the lender discovered a hidden $50,000 personal loan. The legal strategy here is smart and fast. Work with your loan officer on a rapid restore. Pay down specific accounts strategically. Even small, targeted balance reductions can dramatically improve your ratios. Some borrowers improve their DTI by 3 to 5% in under 2 weeks. The fifth viral hack involves down payment money. Someone online tells you to have a friend deposit cash into your account, let it sit for 60 days, then claim it as your own savings. Or worse, borrow money, funnel it through another person, and call it a gift. This is money laundering in the context of a federal loan application. Lenders are required to trace the source of every dollar in your down payment. They request 60 to 90 days of bank statements and flag any deposit over 50% of your monthly income. Large unexplained deposits kill more mortgage applications than bad credit scores. The legal version is simple and powerful. Legitimate gift funds from family members are allowed on nearly every loan type. You just need a signed gift letter confirming no repayment is expected. And here's what almost nobody talks about. Down payment assistance programs exist in all 50 states. Programs in Texas, Florida, California, and dozens of other states offer $5,000 to $20,000 in forgivable grants to first-time buyers. That's free money, no fraud required, no repayment ever. This one should terrify you. Creators are literally selling templates for fake bank statements online, and people are submitting them on mortgage applications. Let's be very clear. Submitting a fabricated document to a federally insured lender is bank fraud, wire fraud, and potentially identity theft. A triple felony. And lenders don't just glance at these documents. Major banks now use AI-powered verification that analyzes fonts, metadata, formatting patterns, and cross-references account numbers against banking databases in seconds. In 2023, Fannie Mae's Day One Certainty System flagged over 100,000 loans for document inconsistencies. A New Jersey couple was sentenced to 41 months each after submitting altered statements showing an extra $200,000 in assets. 41 months in federal prison for a PDF edit. The legal alternative is surprisingly flexible. Asset depletion loans let borrowers qualify using total liquid assets divided over the loan term, even without traditional income. And if savings are genuinely low, FHA requires just 3.5% down. Some USDA loans, 0 down in eligible areas. The last hack is the most brazen. Creators advise you to hand the appraiser inflated comparable sales, pressure them to hit a certain number, or stage a property to hide major structural defects. Attempting to influence an appraisal is a federal crime under the Dodd-Frank Wall Street Reform Act. Period. Appraisers are legally required to report any coercion attempt, and FIRREA, the Financial Institutions Reform, Recovery, and Enforcement Act, imposes penalties of up to $1 million per violation. In 2021, a Florida investor received 4 years for systematically inflating appraisals across 22 properties. But if your appraisal comes in low, you have legitimate recourse. File a reconsideration of value, an ROV, providing comparable sales the appraiser may have genuinely missed. Your agent can compile recent, relevant comps within a half-mile radius. You can also make targeted improvements before the appraisal. Data from the National Association of Realtors shows a minor kitchen update recoups 96% of its cost, and professional landscaping adds 5 to 12% to curb appeal valuation. Now, if you're still thinking, people get away with this all the time, let me explain why that's dangerously wrong. Fannie Mae and Freddie Mac now deploy artificial intelligence that cross-references your application against IRS records, employment databases, property registries, and banking systems in real time. The Mortgage Industry Data Exchange, known as MIDEX, maintains a permanent database of every professional flagged in a fraud investigation. One entry on that list, and your career in real estate is over. But here's the timeline that truly catches people off guard. The statute of limitations for federal mortgage fraud is 10 years. A lie on your application today can result in FBI agents knocking on your door in 2036. And when federal prosecutors do bring charges, mortgage fraud cases carry a conviction rate above 93%. Those aren't odds any rational person should play. Here's the truth that no viral hack video will ever tell you. The mortgage industry today has more legitimate programs, alternative loan products, and buyer assistance options than at any point in history. Non-QM loans serve borrowers that traditional banks reject. Down payment assistance exists in every single state. FHA, VA, and USDA loans offer paths to homeownership with minimal cash required. A good mortgage broker, not a TikTok creator with a ring light, can access wholesale rates from dozens of lenders, match you with the right program for your exact situation, and structure your application to maximize approval odds. Every single hack on this list has a legal equivalent that achieves the same goal. The only difference? One path builds generational wealth. The other one ends with a federal case number and a prison sentence. That's not a choice. That's common sense. If this video just saved you from making a life-altering mistake, or showed you a legal strategy you didn't know existed, drop a comment below and tell me which hack surprised you the most. Subscribe for more mortgage and real estate strategies that actually work and won't land you in a courtroom. And if you know anyone who's house hunting right now, send them this video. They need to see it before they see the wrong TikTok.